accounts for financial statements. And this is covered in the material in Chapter 3 in the course. In terms of our key objectives, what we're going to be doing is describe the purpose of adjusting entries and what they're for. And we're going to explain how the timeliness, matching, and revenue recognition principles affect the adjusting process. We're explaining the concept of accrual accounting and cash basis accounting and how the accrual accounting really adds value to our financial statements. We're going to prepare and explain adjusting entries for prepaid expenses, depreciation, unearned revenues, accrued expenses, and accrued revenues. And we're going to explain how accounting adjustments link to the financial statements. And we're going to explain the concept of preparing the adjusting trial balance. We're going to prepare financial statements from the adjusted trial balance, and we're going to explain how to prepare correcting entries and identify and explain an alternate in recording prepaid and unearned revenues. So first, I want you to think big picture, okay? In terms of the big picture, we have to understand how this basic concept of accounting works. As we've seen in the first couple of units, what we're really doing in accounting is looking at the situation at a start, okay? We're going to call that the beginning of the period. And that period runs for a period of time, let's say a year. It could be a month, could be different lengths, but generally it's a year, okay? So that period starts, we have a record of our assets, liabilities, and owners' equity at the start. Things change during the year. We generate revenues, we incur expenses, things depreciate, and so on. So things move ahead. And here we are now at the end of the period. So very much we've worked our way through. We've seen over the course of the last couple of units how we can record our financial activity along the way. And we're at the end of the period now where we're trying to do a tally up to figure out what is our end assets, liabilities, and owner's equity. So we can kind of get a good sense of what we've done during the period. So these transactions take place. And what happens is as we get nearer and nearer to the end of the period, let's say a week away or a few days away, there are certain things that are already in progress that will carry on over the course of the year, over that period. So basically, let's say, for example, salaries. You start your pay period this past week. It's a 2-week pay period, and the end of your year comes halfway between the two pay periods. So these are the sorts of things that happen. So what we need to do is to make what's called adjustments. And our adjustments are to do exactly that, to concern ourselves with getting an accurate picture of what our revenues and expenses are by considering some of these revenues and expenses that will flow over the end of the period. What I've shown you here is the full accounting cycle. Okay, so here we are in the full accounting cycle. We're identifying business transactions at the start. We're recording these transactions. We're posting these transactions to the general ledger. We're preparing an unadjusted trial balance. And we're posting these adjusting entries now that we've kind of reached the end. And we're going to prepare an adjusted trial balance based on these adjustments that we make. So what we're really looking at in this particular section is 5 and 6. We're almost at the end of the accounting cycle, and we have to do some small adjustments. So that's what we're going to focus on in this particular part. And you can see that Chapter 3 really covers this when we're looking at adjustments and the adjusted trial balance. In terms of adjusting the accounts, financial information, by definition, needs to be timely, in other words, it reflects what's going on now, and accurate. In other words, it truly reflects what's really happening. So financial statements need to be prepared at regular intervals. We know that, and these intervals are little stops along the way. The business keeps on going, but we kind of take a little picture along the way. We'll call it a photograph of how are we at this instant? How are we at this instant? And this is what we call a financial period, really, is to be able to do that snapshot. And so accounting needs to be adjusted or updated to ensure all the revenues, expenses, assets, and liabilities are recorded at the end of that period or at that snapshot. So, generally agreed upon accounting principles, which are the standards of which accountants use in order to be able to measure how well a business is doing, have some key principles that really dictate to us what we need to do at the almost end of the accounting period. If we look at, there are three major ones. First of all, there's something called the timeliness principle. The timeliness principle refers to the need for accounting information to be presented to users and fulfill their decision-making needs in a timely basis. In other words, we need that information now in order to make a decision now. We also look at revenue recognition as a principle, and that is, it requires that revenues need to be recognized on the income statement in the period when they were realized and earned, not necessarily when the cash received. So if we've done some work, and here we are working towards the end of the accounting period, and we're just almost up to it, we've done a bunch of work, we haven't gotten paid for it yet, but we still want to recognize the fact that we've done the work and that money's going to come in. We recognize the revenue. That's what revenue recognition tries to do. Finally, we've got this matching principle, and the matching principle is really one of the fundamental concepts in accounting, and that is, it directs a company to report an expense on its income statement in the period in which the related revenues are earned. So we've got revenues going on in a period, expenses going on in a period. What the adjusting entry tries to do is to actually record that income and that expense in the actual period that it occurred. So these adjusting entries are all important to achieve those goals. We also have to understand here, before we actually get into this to a great degree, is this concept of a cash versus an accrual-based accounting. The accrual base is what we normally use, okay? What we normally use for the purposes of generally agreed upon accounting principle. And what it basically says is revenue and expenses are recognized when earned or incurred, regardless of when the cash is received. So we've gone out, we've done a bit of work, we haven't gotten paid for it yet, but we recognize the revenue because we've actually done the work. We haven't recognized the cash coming in, but we've recognized the revenue, so we're going to record the revenue. A cash basis system, on the other hand, is not something that's used so often, but it's much simpler. It just basically says that you recognize revenue when the cash comes in, and you recognize the expense when the cash goes out. That's not consistent with GAAP, okay? But it is a simple way to recognize revenues and expense. Why bother to do this adjusting at all? I think it's becoming evident, based on what we've talked about so far, that adjusting entries allow us to prepare accurate financial statements. It gives accuracy, which is really what the purpose of an accounting financial statement is anyway, to be able to tell managers or tell outsiders or tell insiders, to give them a fair picture of how the business is doing, right? It's a communication tool. So if it's communicating accurate, timely information, it's a much better form of communication tool than something that is sort of maybe we're not really sure type thing, you know. So the whole idea of an adjusting entry is to make those statements actually very, very clear. So these entries are typically made on the last day of the accounting period to reflect the revenue earned and the expenses incurred during the accounting period. So we're really bumping up against the edge of the accounting period there. So adjusting accounts. There's a bunch of accounts that we need to think about in order to adjust. And accounts are adjusted at the end of each accounting period to bring the asset and liability account to its proper amount. Adjusting entries are also updated that relate to expense or revenue accounts, and the adjustments are necessary for the preparation of the financial statements. So what's typically adjusted? Well, things like revenue accounts that deal with unearned revenue, money that we've got, let's say, for example, we got paid for a job before we've actually done it. That's an example of unearned revenue. How much of that job have we done? 10% of it, 20% of it, 30% of it? Well, the percentage that we've done is what we've earned the revenue for. The percentage that we haven't done, we haven't earned the revenue for. So unearned revenue is really it's what's called a contra revenue account. It's not really revenue. It's just reflecting the fact that we're probably going to earn it, but we haven't yet. And then we got accrued interest income. So we got money in the bank, or we've got money in some sort of investment. We know that there's interest earned, but we haven't really received the interest yet. So we need to figure out how much interest are we entitled to up to the end of the period. And service revenue, we've done a job, we haven't gotten paid for it yet, let's reflect that. In terms of expenses, we need to think about some of the accounts that are often used there in order to do adjustments. For example, any prepaid expenses. We've gone out and we've paid for something in advance, we haven't used it yet. So it's very much an asset to us in the terms of it's going to provide us value at some point in time in the future. Depreciation expense amounts. We recognize that assets need to be used up as their life expires, and we need to account for that by expensing them. Amortization is the same thing. Amortization and depreciation are very similar. Depreciation is usually hard, tangible assets, stuff you can see. Amortization is more for intangible assets, stuff you can't see, such as trademarks and these sorts of things. Supplies expenses, we need to count how much of the supplies we've used. And if we've used 30% of our supplies, we need to expense 30% of our supplies. Salary expense, as I've already given you an example, where, for example, the period ends halfway through the pay period, so we record the portion of the salary that is expensed, and the rest of it is to be paid later. Interest, same way. We owe interest on something, and we have to calculate how much interest we owe to the date of the end of the period. I'll give you an example again of the salary, just a little bit more detail on this. The gray area represents, the gray box represents an accounting period, okay? The first accounting period, the current accounting period. And the red box represents the next accounting period. So one precedes the other. Here we are almost up to the end of the accounting period, the first accounting period. And our salary payment is going to fall, or our salary period is going to fall over into the next period. So what we need to be able to do is to say, okay, if it's halfway through, half the salary is really expensed in the current period, and half of it will be expensed in the future period. So we really need to think about how much salary is expense. How much salary expense do we have, even though we haven't actually paid it yet? How salary expense do we have at the end of our period? Let's look at a simple example here for a company that goes and buys an insurance policy on January 1st, okay? This policy is a 3-month policy, and the total cost of the policy is $1,800. So if we think about it, we'd say, okay, well, that means that 3-month policy, $1,800, that's $600 a month, okay? So you can see January would be $600 worth of insurance, February $600, and March would be $600. Now, when we go buy the insurance, we would simply go out and say, okay, let's record that in our statements. Okay, let's go and record the fact that we've gone and bought something of value here. So if we look at the accounts, the two accounts will be affected. Will be one called prepaid insurance, and the other one will be cash. So we would debit prepaid insurance. We get a value, prepaid insurance, of $1,800 on January 1st, and our cash went down by $1,800 because we went and we basically paid $1,800 for it. So cash would be credited. Now, let's move to the end of January. And let's assume that the company year end is January 31st. So at this time, 1 month or 1/3 of the insurance policy has been used. So the adjusting entry to record the expiry of the insurance for January would be insurance expense will be debited by $600, which is 1 month of insurance, and prepaid insurance will be credited by $600. So that would effectively, if you look at the T accounts below, that would bring the prepaid insurance to $1,200 balance and increase the insurance expense to a $600 balance. So this would be what we consider an adjustment. Another example of where adjusting entries come into play is with depreciation. Now, depreciation, it refers to the expensing away of a value of an asset. So let's just look at the basic concepts here. So companies acquire assets such as equipment, buildings, vehicles, patents, you name it. All of those things are there in the company's fold to generate revenue for the business. These assets tend to last longer than one accounting period, more than a year. Okay? So we say to ourselves, if we're getting value out of it for more than 1 year, we need to reflect that value over the course of time. And as it gets used up, we want to reflect the expense of it over time. So what depreciation does is it allows us to do those two things. So depreciation really allocates the cost of the asset over the expected useful life of the item. So here's what we need to do. So depreciation is based on matching the cost of the asset with the fact that it's going to get used up over time. There's a first and simplest form of depreciation is called straight line depreciation. And all that is, you take the cost of the asset and you subtract away what you think you can get for it when you sold it. So let's say you bought something for $100,000, you figure you could sell it for $10,000. That's $90,000 worth of wear or use on the product. And your job then is to say, okay, let's see how much we have to allocate per year. And if it lasts, say, 9 years, $90,000 worth of depreciation, 9 years, $10,000 a year. That's simply all we need to do there. So here's another example. On January 1st, 2017, a company purchased a piece of equipment for $72,000. The equipment is expected to have a useful life of 4 years and have a residual value of $8,000. Well, how do we do it here? Well, we take the asset cost and we subtract away its estimated residual value. So this particular item costs $72,000. Subtract $8,000 from that, and that gives you $64,000. And what is the estimated useful life on the product? 4 years. So $64,000 divided by 4 is $16,000 a year. So this is a way to estimate your depreciation expense. So let's say we need to record all that. So we're going to go and we're going to buy the piece of equipment first of all. Let's record the fact that we bought it. So the equipment, we got a piece of equipment for $72,000. That's going to be equipment as an asset, debit for $72,000. We paid for cash. Let's assume we paid cash. So in this particular, we took the money out of our bank account. Our cash went down. That's a credit. A year goes by. Okay, we bought it at the beginning of 1 year. We're at the end of the year now, and we say, okay, look, we've used up so much of it. And we said that $16,000 a year is going to be depreciation expense on it. So let's expense some of that. So we're going to depreciation expense, debit by $16,000, and what's called accumulated depreciation on equipment, $16,000 credit. So that's going to be that account that's used in order to figure out how much accumulated depreciation on it. So the entry to record depreciation at the end of the year would simply be depreciation expense and accumulated depreciation for $16,000. As we move into the next year, we do almost identical calculation. The entry to record depreciation at the end of the second year would be depreciation expense 16, accumulated depreciation 16. And you can see that in the T accounts here that depreciation has really increased from 16 to 32 because 2 years worth of depreciation. And the same would take place in the third year. As we move into the third year, another $16,000 of depreciation expense will be added, and our total accumulated depreciation then will be $48,000. The entry to record depreciation in the fourth year would be another $16,000, so a total of $64,000. So effectively what this does is it records the wear on the item as it gets used up. And you can see that the equipment equipment was recorded for $72,000 to start with. As the accumulation gets accumulated on it, it will eventually come up to the total value of the asset less any residual value that you can get by selling. Another typical account that gets adjusted at the end of the period is unearned revenue. So what exactly is unearned revenue? Well, it's cash received in advance for providing products and services. So we actually haven't done the work yet, but someone paid us in advance. Lovely. Nice to happen. Unearned revenue is really a liability because we haven't done the work yet. If we end it tomorrow, we'd have to pay that person back. As products and services are provided, the amount of unearned revenue is decreased and turned really into earned revenues. So here's an example. On March 1st, a company received a $12,000 payment from the customer for maintenance services to be provided over the next 2 months. So someone paid us $12,000 in advance. So we're going to record that simply as debit cash, $12,000. Money came in, cash went up. And unearned revenue, which is a liability account, we need to record that as a credit. So on March 31st, then $6,000 of this revenue had been earned. So we've done some work. So we've got $6,000 worth of earnings there. So what we need to be able to do is decrease our unearned revenue by $6,000 and increase our maintenance revenue by $6,000. So effectively, what we've done is we have generated $6,000 worth of revenue. So we need to reduce our unearned revenue by $6,000. So that effectively, that debiting unearned revenue does that. And we need to show our revenue, maintenance revenue going up. So we credit that. And you can see that reflected in the T accounts. On April 30th, another $6,000 of this unearned revenue has been earned, and the entry to be recorded to the earned revenue would be unearned revenue, again, debit of $6,000, maintenance revenue, credit of $6,000. So effectively what we're seeing here is our unearned revenue now has been wiped out altogether. In other words, we've actually done the work over the last 2 months. So our unearned revenue now has a zero balance, and our maintenance revenue, well, we've done $6,000 worth of work first month, $6,000 the second. That's a total of $12,000. We also look at this issue of accrued expenses. And if we think about accrued expenses, these are expenses that have gathered up and we haven't actually paid them yet. So here we are at the end of our period again. This is the purpose of this accrual. Don't forget now that we're at the end of our period. We're bumping up against the end of the period. We're recognizing that, well, we have some expenses that we really haven't paid yet, and they're called accrued expenses. So these are costs incurred in the period that are both unpaid and unrecorded. So the adjusting entries must be made to record the expense for the period and relate liability. So examples would be interest, wages, rents, taxes, these sorts of things. Let's look at an example. On December 31st, $1,200 of interest has been accrued on a company's bank loan. The payment of interest is not due until January 1st. So the end of our year is December 31st. So we got to record December 31st. So we haven't actually paid it yet. So we know we want to recognize that we have a $1,200 interest expense. So let's record that. So we debit interest expense and credit interest payable will be the credit on December 31st. So in December, the company incurred $3,700 of utility expense. The company has not received a bill. So what we need to do is record the fact that that expense has happened. Utility expense gets debited by $3,700, and accounts payable, meaning we recognize that we got to pay someone. It's going to hold over until the next period until we actually pay it for $3,700. We also have accrued revenues, and these are revenues earned in a period that are both unrecorded and not yet received in cash. So we need to do an adjusting entry for that. So adjusting entries must be made to record the revenue for the period and the related asset at the balance sheet date. So examples could be fees, revenues, interest revenues, rent revenue, and so on. So we'll take a look. So what we need to do here in terms of the actual T accounts is, well, the asset needs to go up. We debit the asset, whatever that revenue would be, cash or whatever, and we credit the adjustment, the accrued revenue adjustment. So here's an example. On December 31st, $16,500 of consulting fees have been earned but not yet recorded or billed to the client. So the entry is going to be accounts receivable. We recognize that someone owes us $16,500. And the revenue would be $16,500 consulting fees. So adjustments are only made when the financial statements are prepared. So we're really bumping up to the end of the period. Can't forget that. They affect both the income statement and the balance sheet, but they don't affect cash, really. There's no cash moving. It's just a recognition of a liability or a revenue or expense or something along that lines. So you can see here we have a little summary diagram of this, and this is a handy dandy tool to have just to kind of have when you're doing examples. This handy dandy little chart is good for understanding what you need to do. Once you've done your adjusting entry, so the point of that is to be able to say, okay, we've reached the end of our fiscal year, we have made our adjustments. Once we've made our adjustments, then we create the adjusted trial balance. Now, the adjusted trial balance is just a listing of all the accounts and the balances that has been prepared after the adjusting entries have been made. So this then would give us an accurate reflection of the account balances post adjustments, and it's used to prepare the final financial statements. So having done the adjusted trial balance, we can actually produce the financial statements by breaking the various accounts into assets, liabilities, owner's equity, revenue, and expenses. The adjusting entries bring the accounts up to date, and that's really what is key, is that it keeps us with the most relevant, timely information possible, and it gives a true reflection of how the business is doing.